Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Tuesday, everybody. First up, let's move through salient developments related to the Chinese economy. According to new official data from the National Financial Regulatory Administration, the average annual rate of return on Chinese insurers' investments last year tumbled to the lowest level in 15 years. Insurance firms' investments yielded 2.23% in 2023, down 1.53 percentage points year-on-year, the lowest rate since 2008. Regular viewers will know that the low returns on insurers' investments is the result of a mixed performance in China's capital markets last year, with the stock market having a dreadful year, but bonds doing comparatively well. And of course, insurers are going to have more bond-heavy portfolios as they are quite risk and volatility averse. Next up for the economy, according to the latest earnings statement, Chinese coffee chain Luckin Coffee Inc. became China's dominant coffee chain in 2023, surpassing Starbucks Corp. In annual sales for the first time. The company posted quarterly net revenue of 7.06 billion yuan, $980 million, a 91% increase year-on-year. Net income rose more than 4 times year-on-year to 296.4 million yuan in the same period. Luckin's total sales in 2023 were $3.34 billion, surpassing Starbucks' annual sales of $3.16 billion in China. It's been a bumpy road for Luckin Coffee. Founded in 2017, it saw rapid expansion in its early years. Then in 2020, its stock crashed almost 97% after a massive fraud scandal. Many of the leadership were replaced and internal processes reformed. Since then, the coffee chain has seen strong performance and a recovery in its stock price. China is a rapidly growing and highly competitive market for coffee consumption. According to a report from the World Coffee Portal in December of last year, China now has the most branded coffee shops in the world, with nearly 50,000 outlets, overtaking the United States in the past year. Part of Luckin's recent success has been due to the hit to Chinese consumer confidence in recent years with the poor economy, making consumers much more price sensitive. Luckin provides very basic and cheap coffee, mostly to go and very minimalistic in terms of cafe features, selling drinks for as little as 9.9 yuan, $1.38 US, a cup, while most Starbucks coffee is priced at least 30 yuan, 3 times that amount. Next up, 2 analysts from Great Wall Securities have penned a commentary today with the Chinese financial media outlet Caixin, warning that China's local government debt control plan could hinder growth in 2024. In the guidelines issued at the end of 2023, the commentary explains, China's State Council mandated a slowdown or halt of certain government-invested projects starting from 2024 in 12 key provincial-level regions. These regions, which were identified as high risk in terms of their debt burden, were Tianjin, Inner Mongolia, Liaoning, Jilin, Heilongjiang, Guangxi, Chongqing, Guizhou, Yunnan, Gansu, Qinghai, and Ningxia. Under the measures, the commentary argues, if infrastructure investment in these regions falls between 10 to 12% in 2024, that could lead to a decline in growth in their overall fixed asset investment of 3 to 6 percentage points. This could potentially reduce growth in fixed asset investment for the country as a whole by between approximately 0.8 and 1.7 percentage points. Therefore, in order to compensate for this drop in fixed asset investment as a percentage of GDP, quote, it is crucial to focus on the role of consumption in driving GDP growth, end quote. However, Beijing has been trying to do just that for many years now, to little success. Meanwhile, the fiscal squeeze on local governments continues. According to a report published by Yuekai Securities Research Institute yesterday, only 5 out of 28 provincial-level regions saw an uptick in land use sales last year. revenue plunged more than 20% year-on-year in 9 of these regions. Jiangsu province on the East China coast saw the most revenue from land sales last year at $131.7 billion, even though this was an 11.3% dive in revenue year-on-year. Neighboring, also relatively wealthy eastern province of Zhejiang, which also hugs Shanghai, ranked second with $89.9 billion, but this was an even more painful 22.4% drop from the year before. 2023 was the second year in a row that China saw falling revenue from land use sales. The report concludes, based on local government fiscal reports, that most provincial governments are bracing for further falls in land auction revenue this year. Evidence that the local government debt and fiscal crisis continues to deepen as we move into this year, a trend which will have a direct effect on growth and wider financial stability in the system. Bond issuance is also down. Bloomberg compiled data published today showed that regional authorities nationwide plan to issue new bonds totaling 1.08 trillion yuan, $150 billion for the first quarter of this year, about 13% less than they sold over the same period last year, and the lowest since 2021. Actual offerings have fallen even more, with new bonds sold by all local governments in the first 8 weeks slumping 56% compared with 2023. Bloomberg writes that Beijing has sought to defuse a $9.3 trillion time bomb in hidden local debt by restricting indebted poorer regions from making new borrowing, adding, quote, China's local governments so far appear reluctant or unable to borrow more, despite pressure to stimulate growth. Fueling expectations, Beijing may pick up the slack and take on more debt, end quote. However, Peking University professor of finance Michael Pettis observed on the news today, quote, but if Beijing does indeed pick up the slack for local government spending, that is not a good thing. The problem with non-productive investment is not who funds it, but rather that it is funded at all. Shifting funding from local governments to Beijing doesn't fix this. End quote. Next up, tensions in the South China Sea. But just quickly, if you're enjoying today's video, as always, it's a huge help if you can like and subscribe. This is the only way in which the algorithm is kept happy and the channel can be shown to new people and grow. Patreon and Buy Me a Coffee links are also in the description below for those who want to help keep the channel financially sustainable. I rely primarily on subscriber support to keep going, so this is a big help too. As always, thank you so much, everybody, for the ongoing support. In an exclusive report this week, UK-based Reuters reports that satellite images of the hotly disputed Scarborough shore in the South China Sea saw a new floating barrier across its entrance, near where Philippine ships and China Coast Guard vessels have had frequent run-ins. One of the images taken last week viewed by the outlet showed the barrier blocking the mouth of the shoal, where the Chinese Coast Guard last week claimed to have driven off a Philippine vessel, which Beijing claims was illegally intruding in its waters. It thus appears that the PRC has put up another barrier at the entrance of the shoal. Beijing actually did this a few months ago, and at that time the Philippines cut it away. Regular viewers know that tensions between China and the Philippines, a US military ally, in the South China Sea have been boiling in recent months, with threats, name-calling, and on-sea collisions all increasing. Responding to the report yesterday, PRC Foreign Ministry spokesperson Mao Ning said that, quote, the Philippines has recently undertaken a series of actions in the waters around the shore that infringe upon China's sovereignty, compelling China to take necessary measures, end quote. Meanwhile, on Sunday, the Philippine Coast Guard accused its Chinese counterpart of jamming the signal of the tracking system of Philippine ships at certain times during recent operations in what they call the West Philippine Sea, briefly preventing these vessels from broadcasting their positions at sea. On Monday, Chinese media hit back, with the state-run Global Times accusing the Philippine Coast Guard of making, quote, fake and fabricated statements, end quote, adding, quote, Chinese experts said that the Philippines is trying to portray itself as a victim by discrediting China's professional and rational law enforcement through cognitive warfare, end quote, adding, quote, if Manila continues its provocation and abuses Beijing's goodwill and restraint, it will incur more severe countermeasures, end quote. despite the fact that much of the coverage of the ongoing tensions in the South China Sea, critical of the Chinese side, has been made by news outlets from countries all across the world, and the vast majority of the coverage in support of China's claims to the region, as well as its behavior towards the Philippines, has been made almost exclusively by Chinese state-run media. In a separate piece from the same outlet, the state-run Global Times accused the Philippines of engaging in a propaganda war in the South China Sea. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Tuesday, and I will see you all tomorrow.